You hear me?
Yes, I can. We're already live because I did an event, so we're being listened to.
What do you mean you did an event?
Well, viewers, let me tell you that you can schedule a restream across all your social media ahead of time and tell people it's coming, which is what we did here. And so in order to do that, you have to start the stream on time at 12, which I did. And so you are behind the scenes of how what's the phrase they say? How the
sausage is made.
How the sausage is made. Exactly. So Andrew and I are about to figure out whether we need to have a conversation prior to starting the show for real. What do you think, Andrew?
Well, I think we can't because we don't want to show all our secrets. So should we begin, Keith? You've got the music?
I do have the music. Let's play it.
Welcome back to That Was the Week, and that was the week for July 9th, 2021. Lots of events, lots of changes, lots of disruption and drama in tech as always. And as so often in the past, and I'm not sure whether this is because Keith has a particularly personal new interest in venture capital, the headlines are all about venture capitalists, Keith. Startup IPO, why not VCs? So the VCs themselves are not only making the sausage, they're being turned into the sausage itself.
I think you're right, Andrew. You know what's so interesting this week is you've done startups, I've done startups, we've done some together. And you know, for most of the time when you have an idea, everyone thinks it's stupid. So your primary experience is being told what an idiot you are, which I think almost any entrepreneur will identify with. And that's been true for me on this venture capital thing, really for the last 5 years. People who know me will know I recently left ADV, my UK fund, after 5 years. And ADV was trying to do some big things, and we did lots of investor pitches, and we were told how stupid we are. And what's amazing about this week is lots of people are agreeing with the thesis. So I got real excited and said the newsletter this week has to be about this thesis, because suddenly, I'm not the lone voice. And what is the thesis? The thesis is that venture capital is turning into a scalable asset class using public company listings as a method. And so there's a great article from the Financial Times. I'm just scrolling through my editorial so we can see it. The New World of Venture Capital, written by Richard Waters at the FT. And the key quote there is that the extent of the transformation is clear. A new private finance system has emerged from the old VC model, and a new, more diverse group of financiers has the whip hand over what has become an important engine for the future of business.
Yeah, can I'm not sure it's particularly surprising. I mean, what you're seeing with the VCs, or the VC industry, is very similar to the media industry and every other industry that's been disrupted by digital, which, of course, the VC community has done so much to finance. We're seeing the appearance of a winner-take-all tiny group of companies, and then the disappearance of the middle. And then I don't know whether you call it a low end. You would call it artisanal, in both a good and a bad way. So it's not really very surprising, is it? I mean, this has happened with every other industry. Why wouldn't it happen with VCs?
Well, I mean, logically, you're right. But the funny thing is that, you would think that fintech, if it was going to target a sector, probably after banking and insurance, the next thing in the list would be investing. Robinhood, which filed for its IPO this week, kind of does that, but that's really disrupting retail investing. Nobody's really disrupted effectively venture until SoftBank came along a few years ago and did the $100 billion SoftBank fund. So that was a major challenge to the growth stage investors. Now Tiger Global is picking up that mantle, which we've talked about on the show quite a bit.
But do you really believe your headline? The headline is Startup IPO, why not VCs? I buy that VCs are becoming the new IPO. And then you ask the end of the Artisan VC. But let's use another industry to think about this.
But I put a question mark.
Yeah, no, I understand that. But let's use the beer industry, for example, or the music industry, where you had radical consolidation, which in turn has created a very vibrant artisanal economy. So why can't the two coexist?
Actually, they will. My editorial is somewhat subtle, but it argues that what's going to happen is that the artisans, who are actually good at what they do, by the way, that the artisans are going to connect up with institutional capital in a more efficient way. Today, what the artisans do, and I've done it, is you go out pitching, sometimes for 1 or 2 years, to raise
pitching. You mean for funds or for
funds? So,
right.
So the VCs themselves have to pitch for funds. And that takes anywhere from, depends how many funds you've done and how successful you are, but anywhere from 6 months to 3 years of pitching. You then raise a fund, and then you invest it, and it takes 3-ish years to invest your money and another 7 to harvest your investment. So after about 13 years, you might have made some money. So it's a highly illiquid and highly unproductive,
but also a very personal one. I mean,
yeah,
it's personal. All built on the ability to sell at a very high level, to meet people. No pension fund is gonna throw $1 billion at a VC through a Zoom pitch or through some sort of analysis of metrics.
No, but let's try to think what the editorial argues is that this is all about to change for a simple reason, that a publicly listed source of capital. So imagine, instead of going pitching all these LPs like Fidelity and so on, there's a publicly listed company with lots of money. Now the managers that qualify can get money quickly from that entity. Even better, as they invest the money into companies, the illiquid investments will be reflected on the balance sheet of that public entity and thus become liquid through the public entity's shares. And so this whole 13-year cycle waiting for liquidity will be shrunk down to probably as little as 3 years. And the access to capital will be shrunk down from however long it takes you as an individual to raise today, down to a matter of 2-3 months. So suddenly, a publicly listed source of capital for venture changes the entire industry.
But I don't understand how it speeds everything up, because, as you say, it takes many years to generate profit, and as an investor.
Yeah.
So why is that going to be speeded up? It's still going to take 7 to 10 years to actually realize profit.
Well, it's speeded up in the following way. This is the interesting it's kind of obvious when you say it, but it's less obvious until you say it. Public companies are valued as a function of future expectations.
Right.
Venture funds are valued as a function of past exits. So a venture fund is trapped in the exits it's already had. A public vehicle is valued according to what it's expected it will do. Now, what that means is if you're, let's take an example of Floodgate Ventures, Michael Maples, and you've made 20 investments and you've had 1 exit, but 19 are still private companies that haven't exited. If a public vehicle is the source of capital into those 19, its shares will anticipate the future value of those 19 companies, and those shares are tradable in real time. So what was previously an illiquid waiting game turns into a very liquid current value of the future assets. And
How
so,
will this affect? Because there's a lot, as you know, Keith, there's a tremendous amount of criticism of the public markets by many different people, but the argument mostly in terms of corporations is it forces CEOs to think in a very short-term way from quarter to quarter because of their share market price. How could that affect VCs? I mean, we don't want VCs thinking in such a short-term way, because then the whole point of VCing is undermined.
well, funnily enough, this came out of the UK, but there is a growing belief, probably the majority belief now, that VCs, even though they have 10-year funds, actually are too short-term. There's the new long-term stock exchange that Sequoia is invested in, with long-term meaning 30, 40 years, for things like climate change and clean energy, and things that require capital to grow. And the phrase that's come to be used a lot is permanent capital. Now, what permanent capital is unlike a fund, which when it gets an exit, distributes all the money back to the people who put the money in the first place. Permanent capital, what happens is a public vehicle makes some investments. The investments succeed and they get a lot more capital back than they originally had. They get to keep that capital and invest it again in the next generation of companies, and thus becomes permanent, or sometimes called evergreen. So a publicly listed VC fund would be permanent and evergreen and be able to be very long-term, much more.
So maybe, Keith, we'll have to rename this show not that was the week or that was the month or even that was the year, but that was the decade. That's what VCs should be calling their media shows. It's not just about VCs, fortunately, this week. Lots of other stuff going on.
Yep.
The political spectacle, some might call it a farce, continues. Google apparently is going to win against accusations of antitrust behavior. But politics is increasingly in the headlines, both in a good and a bad way. What's happened this week on the political front, Keith?
So here's the contents that got my attention this week. Google, by the way, did a public response to the attorney generals of 36 states filing an antitrust case against it. And the public response, it's all about Android and the App Store. So we can get into that. I won't go into the details now, but if you want to talk about it, we can. Then there's quite a lot of news about the FTC firing blanks again.
Hiring blacks?
Blanks.
Oh, that was a Freudian error. I thought you said hiring blacks.
No, firing blanks. And then Trump is widely being mocked for filing a First Amendment.
Trump. I don't want to talk about Trump. He's irrelevant. But the FTC is interesting and important. As we speak, actually, Biden announced that he's going to give, I don't know if he's giving the FTC special powers or he's giving someone special powers to investigate big tech. So this is for real. You can poo-poo it and find all sorts of contradictions in their argument, but this stuff isn't going away, Keith.
Oh, it's definitely not going away. It's one of the primary pillars of the Democratic agenda is to, in quotes, tame big tech. So it's definitely not going away anytime soon. And of course, let me be the first to admit that a Republican administration would be far worse. So I'm not arguing that we should get rid of the Democrats anytime soon.
I'm not sure. It depends which Republican Party won. I mean, if it's the party of Mitt Romney, I don't think it would be far worse for you in terms of regulation. If it's Trump, it would.
As the son of a working class family from the north of England, I could never agree that a Republican government would be better than a Democratic one.
Well, your mother's no longer around, unfortunately, Keith. But I'm guessing that all your ancestors, your relatives now probably vote Tory. So not yours particularly, but the working class, like in America, the
Agreed.
white working class has shifted to the conservatives in the UK and the Republicans in the US. So things are a bit more complicated. But
They are indeed.
how real is, in your view, Biden and Lena Khan and this assault against big tech? Is it all show? Is it a circus, or is it for real?
No, it's for real. I mean, look, they share with all of us hostility to lots of elements that big tech represents. Things like invasions of privacy, things like tracking, things like using their market power to keep growing again at the expense of smaller rivals. So we all know that these things are true, and we all don't like them, me included, by the way. So the real debate is, what is the correct legal instrument to remedy that? And I think that is a real debate. I don't think there's any consensus yet.
It's interesting, Keith, standing back in terms of the two headlines of this week, one about regulation and then the other stuff about VCs, as if the VC world went the same way as big tech and you just had a Google, an Amazon, a Facebook, an Apple. Do you think that the VCs, who don't have the greatest of public reputations, but on the other hand, most people don't know much about them, if you did have the equivalent of an Amazon VC company or an Apple VC company, I think there would be a great deal of hostility and public suspicion of them, and they would themselves come under the spotlight of regulation.
Well, in a way, Andrew, we do have that. That is what SoftBank, Tiger Global.
But no one even knows. You're obsessed with Tiger Global, but you ask the guy in the street. Everyone's heard of Jeff Bezos and Bill Gates, but no one's heard of Tiger Global.
Well, the reason they haven't heard of it is that normal people on the streets aren't allowed to invest in startups because of the SEC rules around being a qualified investor. So investing is inherently elitist anyway. You have to be rich to get richer. That's a rule. Now,
but you believe, and here's where I'm suspicious and skeptical. You think all this is going to change? It's the old story. Technology democratizes. Now everyone can buy stock in VCs. But we heard that about tech, and it didn't happen. All we had was this class of millionaires and billionaires dominating tech and Silicon Valley. Why would it be different with VCs if they go public?
Well, so let's just bring in the news to illustrate. This is, sorry, we've seen that one. It's the next one, this one. This is a British VC, Nick, who runs Forward Partners, who has announced that his fund is going public. Now, what does that mean? Today, you could only invest in his fund. For example, his biggest last investor was Blackrock, the asset management company.
Yeah.
So you had to be Blackrock to invest in his last fund. Once he goes public, you can buy his shares. Anyone can, because now it's public. And he's been through all of the regulatory hurdles to be able to offer his shares to anyone. That is not a small thing.
I mean, I guess in a way, but on the other hand, so that's happened with Amazon. So what? So now you can buy Amazon stock, and Jeff Bezos is worth $200 billion.
Well, there's a difference. You could only buy Amazon when they're IPO'd, which is when most of the growth value had already baked in. This is going to allow you to buy a seed fund manager who's investing at the earliest stage in companies that could become unicorns later. So the multiples of your money that you could earn if he does well, it reflects the same that he can earn. So suddenly you can get the same multiple he can get. That was never been true before. You could only get it later after it's already grown. So this is a vehicle to allow me and you to invest in his fund on day one of him making new investments in a new cohort of startups. And
yeah, I have to admit, it sounds too good to be true. Check your pockets, everyone, before you invest in that one. Keith, how does this impact on your on your database, don't
Yeah.
you need an artisanal investor economy for your database? If it's just three dominant companies, you lose, don't you?
Yeah, that's why the implied critique in my headline is not actually a critique. Artisans are really, really the raw material of the entire industry. They're not going away. What's going to change is, I hope, let me say, first of all, I'm going to try to do this. I don't know that this will happen, is to supply them with capital to more efficiently put money into the companies they think are the best. And if they succeed, to allow individual investors to benefit from that. And the way I'm going to do that is the database I have got ranks the best seed investors. They'll all qualify for money from me.
And what's it called again, Keith? Not that I'm allowing you to self-promote on our show.
Signalrank.co.
Signalrank.co. And do I get a percentage of ownership by allowing you to promote it?
You get my warm regards.
I thought all this was supposed to be good for democracy, for poor people like me buying into these new schemes.
No, you can buy in. You can buy in. I mean, not that I'm allowed to promote it, but we are raising a $5 million seed round right now.
Are you doing a SPAC, Keith? Because SPACs are in the headlines again. SPACs and IPOs, all these changes in the VC economy. How is this sort of SPAC phenomenon connected? They're all bound up with the same disruptive fintech and financial services phenomenon, right?
Yeah. So SPACs are I think the enduring concept to get in your head is liquidity, because venture is inherently illiquid. So SPACs are a way to become liquid via becoming public prior to your company having achieved what would normally be expected to be the goals of becoming public. That is, say, revenue goals. So a SPAC accelerates your ability to go public. It's a mechanism for doing that. This week,
would it be fair to say that SPAC gives more power to the founders as opposed to the sort of the plumbing of the financial system, which used to do IPOs, the big banks?
I think direct listings more do that. A SPAC gives power to the people who organize the SPAC. They basically replace the venture capitalists as the investors.
Right.
So they go out and raise 200, 300, 400 million. Vinod Khosla is a SPAC organizer. So this week it was announced that Nextdoor is going public via a SPAC that Vinod Khosla organized. And here's the numbers. The gross proceeds will be 686 million, of which 270 million is what's called a PIPE, a private investment in public equity. So if you deduct 270 from 686, you're left with 416. Vinod went and raised 416 million. He then went to Nextdoor and said, I want to merge with you, having become public himself. They said yes, and together they're raising another 270 million. And Vinod will end up with, something like 5% ownership in the company.
So to what extent are they the sort of the next generation of corporate raiders? Is Vinod the Carl Icahn of the early 21st century?
The difference there is a corporate raider is taking a mature company and breaking it up. What these guys are doing is taking an immature company, getting ownership in it prior to what they anticipate will be significant growth.
So what you're really saying is that any VC now who is just a VC is probably dead in the water. That they need to be reinventing themselves, their industry, the nature of how they access capital, how they raise capital, how they profit.
Yeah. I'd say they're only dead in the water. There's two things that could happen. That they fail to see what's changing and don't become part of it would have bad consequences. Now, the most protected class are the seed investors, because they are the true artisans, the best ones that really know how to do it.
And that's never going to get replaced. Just as Budweiser have never made a decent beer. There's always going to be a place in the market for the next generation, not IPO, but IPA. That was a good one, wasn't it?
Yeah, think of the guys in the diamond mines that find the diamonds. Now think of the value chain above them. The diamond business is massively automated once the diamonds are out of the mine. But somebody has to find the diamonds. And that's what the seed guys do, men and women, guys in the asexual sense of the word. And they're good at it. So the key is to bring institutional capital to those people and glue together the seed stage, the venture stage, and the growth stage into a single continuum.
So the next headline for the newsletter, Keith, I think needs to be IPO equals IPA.
Or South African breweries, for that matter.
Well, talking of South Africa, Africa is also in the news. One of your pet projects. What's happening on the Africa front with tech and startups this week, Keith?
Yeah, this is a small piece of news related to our prior conversations, but Crunchbase has partnered with Digest Africa to now produce an index report on African investing, which means that the knowledge about Africa is going to improve, and hopefully that will lead to more money flowing there.
Well, this was the week that England beat Denmark in the semi-finals of the Euros. My family wasn't too happy because we were all big fans of Christian Eriksen, but Denmark is also in the tech news, at least with your startup of the week, Keith.
It is indeed, and disclosure, my UK fund does own equity in this company, Pleo. Pleo, we invested in the Series A round.
It was a brilliant investment. Was that you, Keith?
It was done via a partnership with a seed fund, like we've been discussing. It was the partner was Seed Camp. Seed Camp needed more capital to maintain its position in the company, and we supplied that capital.
And was that through your relationship with Seed Camp? I know you're close to Klein.
It's Reshma Sohoni. Saul Klein started Seed Camp, but he now runs his own fund called Local Globe.
Okay.
And Reshma Sohoni, who was his initial business partner, now runs Seed Camp. But
it's all about people. For all these big forces and IPOs and all the rest of it, it still comes down to people. Anyway, Pleo is a platform for corporate finance, financial management. Is that right?
It's for companies actually to manage employee expenses, and so when
very dull but necessary, I guess.
Very dull but necessary. But by the way, just so we don't lose the point, Andrew, it's worth saying when we invested in 2018, we're now at 30 times the money we put in less than 3 years. So what we were just describing about plugging institutional capital into seed managers, this is a great poster child.
I know we always hear this, Keith, but you never talk about the 29 other investments that went to zero. It's like saying, well, I put the money on 26 in roulette and I got 36x of the money, but you forget the times that you lost your money. I mean, it's not as simple as simply 16 or 30 or 50x.
No, I think I can accuse you there of not being enough in the details, because what you're saying broadly is always right at venture. The more companies lose than win, so you're right. But actually, this is a very specific product, which is giving money to seed managers for their best companies to maintain their shares.
Yeah.
So it only goes into the companies that are good. The other one we did was UiPath.
So you only did 2 and you won on both?
We did 5 and we're winning on all 5.
When are these seed companies going to wake up and realize that they're giving investors like you too good a deal and that they need to redo their terms?
It doesn't work like that. Actually, we give them the money for free. So it becomes their money and they get 10% of the profit. So there's no real loss on their side.
Will you give me your money for free, Keith?
Only if you've invested in a Pleo or a UiPath, Andrew.
Well, Pleo, congratulations. Always nice to have a good story coming out of Europe. Does this prove that the European economy is still for real when it comes to startups?
Very much so. Actually, Europe has done better than any other continent in the first 2 quarters of this year in terms of the amount of venture capital raised and deployed into good companies.
And also all the innovation when it comes to fintech, or a lot of the innovation, as you suggest, seems to be happening in London on the stock exchange. So that's good news. And finally, Keith, my favorite moment of the week, tweet of the week.
So this is
another UK story, right?
Another European story, UK, yeah. Bill Gurley championing the fact that what used to be called TransferWise, now called Wise, listed through a direct listing on the London Stock Exchange and was valued at $11 billion, which is more than double what its previous round was valued at, proving that direct listings can work in London as well. And TransferWise, for those who don't know, is a much more inexpensive way of moving money around the world than going through the banks.
When are the banks going to just shut up shop, Keith? They seem to be every new story on this suggests to me that companies like Wells Fargo and Bank of America and Barclays and all these other traditional banking companies cannot survive, can they?
Well, they can't survive as retail banks, I think. I think retail banking is going away.
In 10 or 20 years, will there even be such a thing as a retail bank? I mean, still in America, when you walk in our post-COVID downtowns, the only things that seem to be open are banks and the occasional coffee house. But I don't know what their business model is. I don't know how they survive.
In fact, they can't survive from the money they make from retail banking. Most of their money is debt-based. So they basically persuade you to buy a car or a house using their money, and they.
Well, that's the future. That's what you want everyone to work off. Is the future.
We haven't talked about it much on the show, but I'm a big believer that debt itself is going to be disrupted. I don't think a mortgage makes much sense anymore when you can have fractional ownership of homes using digital methods. I think it's more likely that the appreciation in the value of your home will be shared with a co-investor, and you won't need a mortgage. So that cash that you spend on interest will stay in your pocket to be spent on better things.
Well, very, very radical thoughts from the ever radical, ever disruptive Keith Teare. That was the week for July 9th, another week in which venture capital and the financial industries were profoundly disrupted. Huge changes, which I'm sure we will return to next week, as well as all the stuff going on in Washington, D.C. with Keith's favorite East Coast lady, Lena Khan. Have a great week, Keith, and I'll talk again next week.
Will do.